want to welcome everyone back to the revenue recognition. And on this one, we're going to cover variable considerations that you may have. Now, the reason why you may have variable considerations is because you may receive a bonus for early completion, or penalties for late completion, or a bonus for great work, or customer satisfaction, this type of thing. If you do have variable considerations, what GAAP requires is that you recognize revenue on the expected amount that you will receive, or you may receive. We have two approaches. We have the expected value approach. That looks at every possibility outcome you have and the probabilities of receiving each of those. Or you also can do the most likely, which the company considers the most likely single outcome that you may have. For the example we have, construction of a building to be completed August 1st, we're going to receive $2 million for it. For every week that we completed early, we get $50,000, up to 2 weeks. And for every week that we're late, it's deducted by $50,000. So that's what we have here. If it's 2 weeks early, which would be July 18th, we get $2 million plus $100,000, or $2,100,000. On this one, if it's 1 week early, we get $2,050,000, $2 million on time, $1,950,000, and then $1,900,000 was 2 weeks late. And then over here are the probabilities that we have of completing at those various dates. So for the expected value, we would multiply the two together. So we take $2,100,000 times 22%, and then we take $2,050,000 times 30%, $2 million times 20, $1,950,000 times 18, and $1,900,000 times 10%. To get the expected value, then we add those up and we get expected value of $2,018,000. That would be the amount that we would put in here. Would we expect to receive $2,018,000 for the completion of the building? That's the first approach. The second approach is if the company instead uses the most likely value. Well, the most likely value the company may decide is the $2,050,000. So we would use that amount. Okay. Now the other possibility we would have, so use $2,050,000, sorry. The other possibility we would have is constraint. We have a constraint that exists. On this one, XYZ company provides services to Manatee Company for a fee of $400,000 per year. XYZ may receive a bonus for work completed early and correct, or it could be also based off of employee satisfaction with the company. There's a 30% chance of not receiving any bonus, 40% for $2 million, 20% for $4 million, 10% for $6,000 bonus. For the expected value, we'd multiply each of these dollar amounts by the percentage. And so you say 0 times 30%, 2,000 times 40%, 4,000 times 20, and so on. Well, 6,000 times 10. For the expected value, add those up. So we would have equal to $2,002,000. Okay. It's a constraint though because it's going to be either 2,000, 4,000, or 6,000. Okay. So what the company would do, so the most likely approach would be the 2,000. So we record it for $2,000. The whole idea is so you don't overstate it. Okay. On this one, the most likely approach is higher, so we probably use the expected value approach. This is $2 million, so it's 2,000. So you don't want to overstate your estimates for the revenue that you recognize, and that's what you have there. Now, change in price. This is based on the volume of sales discounts, is what this example is based off of. Brown Incorporated sells sweatshirts for $40 each. We have a policy, you get a 12% discount if you purchase more than 2,000 sweatshirts over the year. Cold Company is just starting and purchased 750 sweatshirts during the third quarter. Brown does not believe that Cold Company will meet the discount threshold, so we don't worry about the threshold. It's the 12%. However, during the fourth quarter, they purchased an additional 1,500 sweatshirts, which got them over the 2,000 mark. Okay, but for the quarter 3, we don't worry about it because we don't think they're going to do it. So we have cash would equal to 750 times the 40, or $30,000. Sales revenue. Again, anytime I use cash, keep in mind it could also be accounts receivables. Okay. Now, On this one, what we have, a problem. They ordered the 1500. So they should have gotten a discount on the first one. Okay, so we have to figure out what would be our revenue that we would have. So we'd have equal the 1500 times the 40 times 1 minus 0.12. Now I'm going to do this because you don't officially have to do this, but a lot of people like doing this because I want to really calculate that first. So that gives me $52,800. That would be my revenue for the quarter. However, I need to subtract off the overcharge from last quarter, which was the $40 times the 12%, or $3,600. Now to take care of that, I can put a minus sign in front of there, so then all I have to do is add them together, because that's what we overcharged last quarter, so they get that discount, if you will. So this time we're going to recognize revenue of $49,200. So cash will be for our accounts receivable, will be for $49,200, which we calculated below, and sales revenue will be for $49,200. Okay, that is the changing the price. So that concludes this part of it, and for the next part we're going to go into long-term capital projects.